Hello, everyone. This is Olga Levinson, Coty's Senior Vice President of Investor Relations. Thank you for joining us today for the prepared remarks portion of Coty's first quarter fiscal 2026 earnings. On Thursday, November 6, 2025, at approximately 9:30 a.m. Eastern Time or 3:30 p.m. Central European Time, we will hold a separate live Q&A session on our results, which you can access via our Investor Relations website. Joining me for our presentation are Sue Nabi, Coty's CEO, and Laurent Mercier, Coty's CFO. Before I hand the call over to Sue, I would like to remind you that many of the comments today may contain forward-looking statements. Please refer to Coty's earnings release and the reports filed with the SEC, where the company lists factors that could cause actual results to differ materially from these forward-looking statements. In addition, except where noted, the discussion of Coty's financial results and Coty's expectations reflect certain adjustments as specified in the non-GAAP financial measures section of the company's release. Thank you. I will now turn it over to our CEO, Sue Nabi.
Thank you, Olga. Welcome, everyone, and thank you for joining us today. After 4 years of industry-leading growth and expansion through fiscal 24, followed by a more challenging calendar year 25, we are committed to reaccelerating our performance and doubling down on our strengths. The early results from our recent operational interventions are promising. We are improving our core prestige fragrance performance, accelerating in adjacencies such as ultra-premium fragrances and fragrance mists, and remain focused on building our footprint in prestige, makeup, and skincare. We've shown strong progress in improving our execution in U.S. prestige, with the U.S. being our number one headwind in fiscal 25. We are acting with urgency to transform our consumer beauty business while progressing with our strategic review. And we remain laser-focused on strengthening our profitability and balance sheet, with our fiscal year 26 business trends steadily improving in line with our expectations. As we solidify our position as a global prestige beauty company with an emphasis on fragrance and scenting across price points with cosmetics and skincare capabilities, our goal remains delivering strong, consistent performance and outperforming the beauty market. In the first quarter, total net revenues declined 8% like-for-like, in line with our expectations and guidance. Encouragingly, like-for-like sales trends improved in both prestige and consumer beauty divisions. These sequential improvements reflect the early impact of our strategic interventions, including targeted inventory actions and a renewed focus on our core growth engine, fragrances, and scenting. While the environment remains promotional and some pressure persists, our top-line trajectory is moving in the right direction. Our fragrance portfolio continues to be a key driver, with standout launches and expansion as consumers continue to prioritize fragrances as affordable luxuries. We are encouraged by the progress, and we remain confident in our ability to build momentum as we move through fiscal year 26. In prestige, we saw sequential improvement in like-for-like sales trends as anticipated. Sales declined by 7% like-for-like in Q4, improving moderately to a 6% like-for-like decline in Q1. We are, of course, not happy with this performance as we continue to face a bigger gap between sell-in and sell-out than many of our peers, following several years of outperformance versus our peer group, which likely also drove retailers to stock up on Coty's blockbusters. As we further shrink the sell-in and sell-out gaps and reinvest behind our brands to drive stronger sell-out during the holidays, we expect further prestige like-for-like trend improvement in Q2. In consumer beauty now, we are also seeing signs of sequential improvement. Like-for-like sales declined by 12% in the fourth quarter and 11% in Q1. We anticipate further improvement in Q2 as the new divisional leadership drives operational changes. The broader beauty market is moderating after several years of exceptional growth. However, fragrances continue to outperform, benefiting from a structural shift towards affordable luxury, often described as recession glam or tritonomics. The prestige fragrance category has grown at a mid-single-digit pace in the last 3 quarters, even as other consumer categories languished. Fragrance volumes were up low single digits in Q1, reflecting sustained demand. The mass cosmetics category saw a sharper slowdown in fiscal 25, though we are seeing some trend improvement to low single-digit percentage growth in Q1. These dynamics underscore the importance of agility in navigating the evolving beauty landscape. Against this market backdrop, we saw diverging dynamics between our sellout and sales performance in each division. In prestige, the prestige beauty market grew 6% in Q1, reflecting strong consumer demand across categories, while our sellout grew 1%. Specifically in prestige fragrances, which is our core category, the market grew by 5%, while our sellout grew around 2%. The couple percentage points gap between the prestige fragrance market and our prestige sellout reflects the timing of our Boss Bottle Beyond fragrance launch at the end of the quarter and our more disciplined approach to elevated promotional activities we see in many markets. As anticipated, our prestige sell-in tracked well below sellout due to ongoing retailer destocking, though this gap narrowed from the double-digit gap we saw in Q4. Our actions to right-size inventory levels are impacting near-term results, but are necessary for a healthier trajectory ahead. In consumer beauty, the dynamics are different. While the mass beauty market grew 2% in Q1, our sellout declined 6% and sell-in declined 11%, driven by rapid channel shifts, media investment reallocations away from lower return areas, and competitive pressure. These dynamics underscore the importance of our performance improvement plan for the consumer beauty color cosmetics business, alongside the ongoing strategic review. Now I want to take a moment to discuss the progress we're making to address the challenges we faced in fiscal 25. One of our top priorities has been to address the challenges we faced in the US market, which accounted for the vast majority of our sales declines in 25. In the spring, we announced the new regional structure to make Coty nimbler and more aligned with today's evolving channel landscape. We also appointed new leadership in the US, and we are now benefiting from a seasoned leadership team and an overarching regional structure that adds another layer of experience and agility. These adjustments are yielding positive green shoots as we close the gap between our US prestige fragrance sellout and the overall US prestige fragrance market from an approximately 5-point gap in Q4 25 to full alignment with the market in Q1 of fiscal 26. This progress validates the impact of our organizational and commercial interventions and reinforces our confidence in returning to outperformance in the US market. More effective leadership, sharper execution, better alignment between sell-in and sell-out are driving meaningful improvement across our key metrics in the US. In Q1, we closed the gap between our US prestige fragrance sellout and the US market, with both growing approximately 7%, reflecting the impact of targeted interventions and commercial actions. We expect to broadly maintain this alignment in the coming quarters. While our US prestige revenues have tracked well below our sellout over the last 3 quarters due to retailer destocking, inventory trends are improving. With our solid sellout growth in the last 2 quarters and assuming the prestige fragrance market continues to grow at a similar pace, we expect our US prestige sell-in to return to growth in Q2. These results demonstrate Coty's agility and commitment to returning to outperformance in our largest market. We have taken decisive steps to fundamentally improve Coty's ROI and operational efficiency. The next phase of All In to Win is underway, targeting significant fixed cost savings across the organization. Our newly established Performance and Operational Excellence Office is reinforcing operational oversight focused on consistent performance tracking and improving ROI. In Q1, we generated over $40 million in productivity savings and more than $10 million in fixed cost reduction. We remain on track to deliver approximately $200 million in combined fixed cost and productivity savings in fiscal 26, giving us the flexibility to reinvest in growth, offset inflation, and support profit expansion. In light of the tariff landscape, Coty has taken decisive steps to reinforce here again our competitive advantages. We transferred some production of US-bound fragrances to our domestic plant, including mass fragrances, Adidas and Nautica, and also fragrance mists. We will continue to transfer additional fragrance products and adjacencies while we assess the final scope, prioritizing return on investment. All of these actions reinforce Coty's resiliency and relative cost advantage versus our peers who continue to produce primarily in Europe. With the recent tariff updates, we now expect a gross tariff impact of under $50 million for the year, with a net impact of under $40 million, which is approximately $20 million lower than our assumptions several months ago. As we discussed last quarter, our digital and e-com teams are now embedded within local markets and brand organizations. This structure enables omnichannel execution and empowers commercial decision-making at the local level. In Q1, our e-com sellout grew mid-single digits in both prestige and consumer beauty, reflecting the effectiveness of our strategy and the demand for our brands online. As shared last quarter, we are accelerating AI implementation across Coty with a new roadmap to embed digital innovation throughout our operations. A few priorities include content automation with agentic AI, smarter decisions through predictive analytics and visualization, and better user experiences through chatbots. Plus new AI assistants in procurement, for instance, which are transforming contracts and negotiations. And with the rise of agentic shopping across retail platforms, we are already developing and integrating tools to enhance the shopper experience, including selection optimization and virtual try-ons. These initiatives are optimizing fixed cost investments across back-end functions and reducing the cost of content creation, freeing up funds for working media. We're already seeing some early benefits and expect them to ramp up over the coming years. Now let me turn it over to Laurent to discuss our financial results and outlook.
Thank you, Sue. Our Q1 results were in line with expectations and guidance. As we navigate the complex external environment and implement necessary changes within Coty, we remain focused on steadily improving our performance trends throughout fiscal year 26. Our Q1 adjusted gross margin was 64.5%, in line with our expectations. This represents a decline of 100 basis points compared to the prior year, which reflects lower sales as well as a 40 basis points headwind from tariffs. Despite near-term sales and gross margin pressure, we maintained strong support for A&CP in Q1. Our A&CP investment was approximately 26% of net revenues, up 110 basis points from the prior year. This demonstrates our ongoing commitment to invest behind our brands to drive consumer engagement, long-term growth, and value creation. Adjusted EBITDA declined 18% in Q1, in line with guidance. The decline primarily reflected lower sales and lower gross margin, partially offset by lower fixed costs. Our disciplined approach to cost management and operational efficiency helped mitigate some of the top-line pressures even as we invested behind our brands and strategic priorities. Our Q1 adjusted EPS, excluding the equity swap, was 15 cents, in line with expectations. As discussed last quarter, we have launched the next phase of our All-in to Win program, targeting $130 million in annual fixed cost savings by fiscal year 27, alongside ongoing productivity savings. In Q1, we generated fixed cost savings of over $10 million, in addition to over $40 million in productivity savings. We continue to expect about $200 million in cumulative savings in fiscal year 26. Altogether, our cumulative savings under the All-in to Win program is close to $900 million between fiscal year 21 and Q1 fiscal 26. These savings provide us the flexibility to reinvest in growth, offset inflation and other cost pressures, and support profit expansion. Shifting to our cash flow and balance sheet, we generated $11 million of free cash flow in Q1, an improvement of $19 million versus last year. As a result, we ended Q1 with leverage of 3.7, up 0.2 turns from the end of Q4, primarily driven by lower EBITDA. With strong seasonal free cash flow expected in Q2, we anticipate leverage to come down again exiting next quarter. Deleveraging remains a key objective for us, and we are currently actively pursuing the monetization of Wella. On the balance sheet side, in Q1, we successfully refinanced $900 million of calendar year 26 debt maturities at an attractive cost of approximately 5.6%, with strong participation from investment-grade investors. We continue to expect seasonally strong Q2 free cash flow of over $300 million, supporting first-half free cash flow of over $350 million, which should cover the remaining portion of our calendar year 26 maturities. And in parallel, our focus remains on deleveraging and smoothing out our maturity towers. These actions reinforce Coty's financial position and reflect our disciplined approach to capital allocation, ongoing deleveraging, and risk management as part of our goal to become an investment-grade company. As we move into Q2, consistent with what we discussed last quarter, we expect sequential improvement in sales and profit trends versus Q1. The organizational changes underway in the US continue to yield results and should continue to build through the year. We still anticipate net revenues to be negative in the first half, as strong contribution from innovation, new subcategories, and distribution gains are offset by headwinds from trade inventory reduction, a more promotional environment, and elevated year-over-year comparisons. Importantly, we anticipate net revenues will turn positive in the second half, supported by new launches, alignment between sell-in and sell-out, and easing comparisons. Lower sales, a net negative impact from tariffs, and the anticipated restorations of variable compensation are weighing on EBITDA in the first half. However, we expect positive EBITDA in the second half, supported by a return to sales growth, stepped-up contribution from tariff mitigation, and the full benefit of our fixed cost savings initiatives. Let me share more concrete guidance for Q2. We continue to expect a gradual improvement in sales trends through fiscal year 26 from the Q4 25 like-for-like levels. With strong sales in October, particularly in prestige, we expect Q2 like-for-like sales to land at the more favorable end of our prior guidance of -3% to -5% like-for-like, with sequential trend improvement in both prestige and consumer beauty. We estimate a low to mid-single-digit Forex benefit on our reported revenues in Q2. We anticipate continued gross margin pressure in Q2, driven by lower sales and a sequentially higher net impact of tariffs. Fixed cost savings from the All-in to Win program are expected to broadly offset the negative impact from the resumption of variable compensation. We do expect quarterly phasing of net fixed costs to fluctuate as savings build over the year, while the year-on-year negative impact from variable compensation will be most pronounced in Q2 and Q3. We continue to expect gradual profit trend improvement, with adjusted EBITDA declining by a low to mid-teens percentage in Q2, consistent with our prior guidance. Importantly, with declining Fed rates and some benefit from cross-currency swaps, we expect quarterly P&L interest expense to remain broadly consistent with our Q1 interest in the $45 to $50 million range, resulting in annual interest expense of around $190 million. This reflects roughly $25 million in interest savings year-on-year, or a 2 cents EPS benefit. Therefore, we expect Q2 adjusted EPS, excluding the equity swap, of 18 to 21 cents, bringing the first half adjusted EPS, excluding swap, to 33 to 36 cents, consistent with prior guidance. We continue to estimate seasonally stronger free cash flow in H1 fiscal 26 of over $350 million, resulting in leverage at the end of calendar year 25, approximately in line with a Q4 25 leverage level of around 3.5 times. Turning now to our outlook for the second half. We continue to expect our like-for-like sales to return to growth in the second half as sell-in and sell-out reach alignment, and supported by several key launches in prestige, as well as more favorable comparisons. We also expect to return to adjusted EBITDA growth in the second half, targeting around $1 billion in adjusted EBITDA for the year. While this outlook implies very strong year-over-year expansion in our second half EBITDA, it is important to remind that this is off very low prior year comparisons, particularly in Q4 25. On a two-year basis, our EBITDA outlook for second half fiscal year 26 is a few percentage points higher than second half for fiscal year 24. The expected profit growth will in turn fuel adjusted EPS growth in the second half. Our goal is also to continue deleveraging in calendar year 26 as we target reaching an investment-grade profile. Now, let me turn the call over to Sue to discuss our evolution in lockstep with the beauty market.
Thank you very much, Laurent. Coty has always been a best-in-class fragrance operator, and in this next phase, we are doubling down to become a fragrance and scenting powerhouse from $5 to $500. This is a category where Coty has a proven right to win, backed by leading R&D and IP, manufacturing, marketing, and distribution capabilities, combined with a very attractive brand portfolio. First, we have the strong, long-duration portfolio that provides a solid foundation for sustainable growth. Developments in the beauty and luxury industry over the past year all confirm that the winners in beauty have been and will remain specialized beauty players like Coty. In-housing beauty remains incredibly complex and costly for non-beauty players, reinforcing the appeal of the licensing model. Licenses offer strong ROI with no material upfront license or renewal costs, while established brand equity increases the probability of success and payoff. A successful licensing business depends on portfolio diversification and minimizing license duration risk. In recent years, we have proactively renewed and significantly extended many key licenses, including Hugo Boss, Marc Jacobs, Adidas, and Davidoff for an additional 15+ years. Today, 85% of our portfolio is either an own brand, a perpetual license which we view like an own brand, or a license with very long-term remaining duration of 7 years or more. Even when looking at our core beauty portfolio, approximately 80% of our brands are either owned or under long-term license. We have also been prudent in ensuring that no single brand in our portfolio accounts for more than approximately 10% of our sales. With the public announcement that the Gucci license will no longer be part of our portfolio after its expiry, our focus for the next several years will be on overdriving the brands with the biggest long-term growth potential, building and amplifying our newly added licenses and brands, and in parallel, optimizing the Gucci brand during its remaining term. The second critical point is that Coty maintains a top position in global fragrances. We remain a top 3 global fragrance player with leading positions in both prestige and mass fragrances. In the highly attractive $50 billion prestige fragrance market, Coty is a top 3 player with 12% market share. Importantly, even excluding the Gucci license, Coty solidly remains the number 3 player in prestige fragrances, a position we aim to boost further by overdriving our core brands and doubling down on our new licenses. Among the top 5 global fragrance players, only Coty and L'Oréal operate licensing models, meaning luxury brands have limited partners capable of building scaled, global, and importantly, multi-category beauty businesses combining prestige fragrances and prestige cosmetics. With this backdrop, we continue to attract new and desirable licenses, most recently adding Swarovski, Etro, and Marni to our portfolio, reinforcing Coty's position as a preferred partner for luxury brands. We also lead the mass fragrance market, a $7 billion category across developed markets which grew over 10% in Q1. Coty holds the number 1 position with 12% market share, well ahead of peers, positioning us well to expand our portfolio with new internally created and licensed brands. Our dominant position across all fragrance price points is a core strength, as the category carries higher barriers to entry and stronger consumer loyalty than many other beauty categories. Success in fragrances is anchored on technical superiority and performance, internal fragrance development, and brand names that are both desirable and aspirational. In fact, approximately 90% of the top 20 global prestige fragrance brands were designer brands in 2019 and in 2024. This trend holds even among more price-sensitive Gen Z consumers. In the latest Piper Sandler US Teens survey, 16 of the top 20 fragrance brands among male teens were designer or ultra-premium brands. All of this underscores that even in a fragmented beauty market with many new entrants, the fragrance category remains remarkably stable, with brand equity serving as a key competitive moat. Furthermore, our best-in-class fragrance capabilities and our desirable and complementary designer brands will continue to fuel our strong position in prestige fragrances, while our unique portfolio, which also extends to more affordable consumer beauty fragrance brands, will allow us to capture opportunities in the prestige-inspired juice trends. With designer brands remaining critical to success in beauty, Coty's portfolio of leading designer fragrance and prestige cosmetics brands is a key asset. We have nurtured and elevated each of our core brands, delivering exceptional growth across our designer brand portfolio over the past 6 years. Between 2019 and 2025, at constant currency, we've grown Burberry by an impressive 141%, Hugo Boss by 33%, Chloé by almost 70%, and Marc Jacobs by almost 50%. These results highlight Coty's ability to unlock long-term value through strategic brand building and innovation across our designer portfolio. Importantly, we have delivered similar momentum and success behind brands exiting the portfolio as we grew Gucci Beauty by 61% between 2019 and 2025 at constant currency. Building on this, we have an exciting pipeline ahead with major launches and category expansions across our portfolio. We remain on track to launch Marc Jacobs makeup in calendar year 26 with a very distinctive and craveable assortment. Under Etro, we are already taking steps to strengthen the brand visibility with consumers. Our re-promotion of Etro Nectar, an orange blossom fragrance, has resonated with consumers since its relaunch, setting the stage for what's next. Building on this momentum, we are preparing for Coty's produced fragrance launches starting in calendar year 26, a significant milestone in our partnership and expanding Etro's presence in the prestige fragrance market. We expect to launch Beauty under Marni in calendar year 27, further expanding our reach and category presence. Looking ahead to calendar year 27, we see a tremendous opportunity for Swarovski, another newly added license. This launch will unlock distribution in over 2,000 Swarovski doors, in addition to the tens of thousands of traditional beauty retail doors. In parallel, we continue building on our multi-year track record of leading fragrance innovation. Our Boss Bottle Beyond launch is already resonating with consumers across markets. I'm very excited to share that Boss Bottle Beyond is on track to be the #2 male fragrance launch of the fall in Europe, including the #1 male fragrance launch in Germany in units and the #1 male SKU in Australia. The launch is elevating the Hugo Boss brand equity, strengthening our position in male fragrances, and unlocking a significant opportunity in the US, where Boss Bottle Beyond is already the #6 innovation, despite limited historical presence. We also have a major prestige fragrance launch in the second half under a key brand. As we double down on fragrances, we're integrating our prestige and mass fragrances capabilities more closely, leveraging scale across R&D, consumer insight, fragrance library, manufacturing, and distribution to strengthen our revenue and profit engine. This coordination will amplify our mass fragrance portfolio. Adidas Vibes marks our largest mass launch in a decade, showcasing the strength of Adidas brand and Coty's execution. This launch marks the foundation for a global mass scenting platform designed to expand across categories and geographies. We continue to roll out our internally developed scenting projects with key retailers to drive incremental sales and expand distribution. Building on the booming trend in Arabian fragrances, we recently launched our internally developed fragrance collection, Jawhara, on Amazon in the US, as well as several retailers across Europe. While the launch is in early days, we have already seen some positive results in Germany, with Jawhara already amongst Coty's top 10 female eau de parfum in sell-out. We will continue leveraging consumer insights and global reach to continue capturing opportunities across scenting formats, trends, and price points. Beyond traditional fragrances, we are unlocking new scenting adjacencies within our portfolio. This includes expanding into ultra-premium fragrances and innovative categories that complement our core fragrance business. Our approach positions Coty to lead in emerging scenting opportunities, creating incremental growth platforms that extend the reach and relevance of our fragrance brands. Two of the fastest growing fragrance subsegments are ultra-premium fragrances and fragrance mists, positioned at the high and low end of price points, respectively. These subcategories are highly complementary as consumers increasingly embrace scent stacking, a trend rooted in Arabian traditions. Many consumers use fragrance mists as a base, layering premium or ultra-premium scents on top for longevity and for personal expression. With these trends accelerating, Coty is ramping up efforts to capture our fair share in both segments. Ultra-premium fragrances now represent over 10% of the prestige fragrance market, yet account for only 2% of Coty's first quarter prestige fragrance sales, highlighting here a significant opportunity for expansion. At the other end, fragrance mists make up roughly 10% of the total fragrance market. While our presence in mists was previously limited, recent launches under multiple brands have grown mist contributions to 1 to 2% of Coty's Q1 fiscal 26 fragrance sales. We see here substantial room to grow in both ultra-premium and mist segments and are committed to capturing our fair share over time. Coty's ultra-premium fragrance collections delivered 17% sales growth in Q1, driven by strong consumer demand and the appeal of our differentiated offerings, including our Chloé Atelier des Fleurs, Jil Sander Olfactory Series 1 collections, and Infiniment Coty Paris. This performance highlights our ability to capture growth at the high end of the market and reinforces our strategy to expand in segments where appetite is accelerating. Speaking of ultra-premium fragrances, I want to highlight our latest limited edition launch under Infiniment Coty Paris, Ambre Antique. Originally introduced in 1905, Ambre Antique revolutionized perfumery and defined the modern olfactory family of amber fragrances. Now, 120 years later, we have revived this iconic creation, which is a tribute that honors the original spirit and formula, blending heritage and innovation together in a way that only Coty can. As we shared last quarter, we are the first and only global beauty player embracing the fast-growing fragrance mist market. In recent months, we've launched mist collections under Calvin Klein, Philosophy, Kylie, Adidas Vibes, Nautica, and Jawhara, with plans to launch mists across over a dozen of our prestige and consumer beauty brands. Mists are affordable, complementary, and strongly profitable, with similar margin contribution to our core fragrance business. They also unlock to Coty access to the rapidly growing $7 billion fragrance mist market. Fueled by these launches, mists contributed 1 to 2% of our total fragrance sales during the quarter. I'm proud to share that our patented mist launches are all off to strong starts. Importantly, the results confirm that fragrance mists are incremental to the fragrance-based business of each of our brands, boosting overall sales. After only a few months in market, our Calvin Klein mist collection of 4 scents is already the number 4 fragrance mist brand in Europe and the number 1 mist brand in Italy. And the incrementality is evident, with total Calvin Klein fragrance sellout growing at a mid-single digits %, with growth in both fragrances and fragrance mists. Our recent launch of Philosophy fragrance mist is also igniting excitement for the brand. In recent months, Philosophy's overall fragrance sellout grew double digits, with both growth in core fragrances and mist showing particular strength at Ulta. At the end of Q1, we launched Kylie Cosmetics fragrance mists featuring sweet gourmand scent profiles. Once again, we've seen strong incrementality, with total Kylie fragrance sales up double digits in Q1, fueled by the successful Cosmic Kylie Jenner 2.0 fragrance launch and strong reception of fragrance mists. These mist launches showcase Coty at our best, spotting trends early, deploying them across our brands with agility, and designing the products for profitability with comparable margins from the start. The vibrant, modern packaging, on-scent trends, and accessible price points make our mist stand out at key retailers, attracting Gen Z consumers and supporting the layering phenomenon as our beauty advisors encourage pairing mists with traditional perfumes. And building on our success in traditional fragrances and our extension into mists, we're working to extend into complementary scenting categories, with more details to come in the coming quarters. As global temperatures rise, scenting will become increasingly pervasive in daily life across product types, and Coty will be at the forefront. These adjacencies represent incremental growth opportunities and reinforces Coty's strategy to lead in scent innovation across multiple touchpoints. We're also steadily building our prestige cosmetics and skincare businesses. In prestige cosmetics, Kylie Cosmetics continues to perform exceptionally. Global sellout grew double digits both Q1 and calendar year to date, driven by strong momentum across makeup and fragrances. And growth is also broad-based geographically, with momentum across all major markets, including the US, Europe, and travel retail. Kylie is now a balanced business with strong pillars in lip, complexion, and in fragrances. And for Burberry makeup, we are focused on fueling our recent launches of Beyond Wear blush and loose powders. Now on skincare, each of our brands is anchored in its unique expertise and brand identity. Orveda, the longevity expert, doubled like-for-like sales year-over-year off a small base. Lancaster, our photo-aging and repair expert, is accelerating in China with our Q1 skincare sellout nearly doubling. In fact, Lancaster is now ranked within the top 15 UV care brands, and our recently launched Lancaster Golden Lift is now ranked within the top 30, confirming that Coty is capable of driving growth and building its position in the world's most competitive skincare market. And Philosophy, our new beauty brand, grew double digits year-over-year. Together, these brands position Coty to steadily scale within skincare. Our prestige business continues to gain momentum in China, including Hainan, which represent roughly 3% of our sales. Coty's Q1 China sellout grew 15%, more than double the market, even as our net revenues were lower due to destocking. Fragrances remain the fastest growing category in China, and our sellout was 1.5 times the market. In makeup, we grew at twice the market, and in skincare, we expanded approximately 10 times the market, fueled by the momentum we are building in Lancaster skincare. These results reflect the strengths of our portfolio and targeted execution in the region. And within our global travel retail business, we saw solid growth this quarter, led by a recovery in Asia. As we strengthen our fragrance leadership across price points and expand into ultra-premium fragrances, mists, and scenting adjacencies, we have launched a full performance plan for our consumer beauty business and in parallel, a strategic review. In consumer beauty color cosmetics, we are focused on transforming the business while pursuing a strategic review. Our portfolio includes iconic brands, including scale brands such as CoverGirl, Rimmel, and Sally Hansen, alongside medium-sized brands such as Max Factor and Bourjois. The business generated sales of $1.2 billion in 25, with strong gross margin of over 60%, though profitability has been modest. The mass cosmetics market faced pressure over the past year, but is now returning to moderate growth. Our near-term objective is for the new consumer beauty leadership team to drive execution and strategy for meaningful operational improvements. This will generate value for Coty regardless of the strategic review's outcome. Since announcing our strategic update in late September, we have moved quickly to achieve our objectives. Gordon Von Bretten, Coty board member and former Chief Transformation Officer, has rejoined the Coty Executive Committee as the President of Consumer Beauty. This new role gives Gordon end-to-end responsibility of consumer beauty, spanning innovation, manufacturing, marketing, and of course, distribution. In recent weeks, he has appointed his leadership team, composed of key leaders from within Coty, and they are now in the process of filling key roles at the next level. A pivotal role within the new consumer beauty leadership team is our new EVP of Global Brands and New Product Development, who previously led the Kylie Cosmetics business and helped drive brand growth by over 30% in the last 2 years. She is streamlining core innovation to focus on fewer, high-impact initiatives while complementing with trend-driven launches. The team is actively shaping the color cosmetics transformation program with the full plan to be finalized by Q3. The second part of our consumer beauty business under evaluation is our distinct end-to-end Brazil business. It includes iconic local brands, Monange, Risqué, Paixão, and Bozano, generating nearly $400 million in sales with strong operating margins. These brands remain highly relevant locally with sustained market share gains in nail, in skincare, and in shower gels. Our Brazil business also benefits from a best-in-class platform spanning local go-to-market, R&D, manufacturing, and digital capabilities. Importantly, our Brazil business is quite distinct and operated fairly independently of the rest of Coty. Our desirable local brands, strong management, and top-tier platform have fueled sustained market share gains in our Brazilian business, especially in beauty-oriented categories. Risqué, our nail brand, remains the number one brand in Brazil, growing market share by over 400 basis points in the last 2 years to 34.4%. We have also expanded market share in skincare by 140 basis points and in male beauty by 390 basis points. Touching briefly on our continued digital momentum. Despite retailer destocking and cautious inventory management, even in e-com channel, our sellout trends remain strong across the business. In Q1, our prestige sellout grew 5% and our consumer beauty sellout grew 6%, while revenues were lower due to trade inventory reduction. Social media advocacy continues to fuel strong momentum across our portfolio. Burberry global earned media value from influencer activity nearly doubled year-over-year, and our outstanding 360 activation for Boss Bottle Beyond drove Hugo Boss EMV to grow tenfold versus a year ago. In consumer beauty now, Adidas Vibes continues to resonate particularly with Gen Z, driving a doubling of EMV for the brand. Rimmel's EMV also grew by over 30% year-on-year. We continue expanding our e-com distribution. While we partnered early with Amazon, several of our prestige brands have not yet listed on the platform. This summer, we added Marc Jacobs to Amazon's premium beauty marketplace. The launch has been strong on Amazon, and we have seen a clear halo effect with total Marc Jacobs sellout in the US up 11% since the Amazon launch, a notable acceleration from pre-launch trends. Finally, we continue making strong progress on our ESG commitments, reaching new milestones that reinforce Coty's leadership in sustainability and in transparency. This quarter, we published our fiscal 25 sustainability report, our first disclosure under the EU Corporate Sustainability Reporting Directive, or CSRD, advancing transparency and data integrity. Let me highlight a few of the key takeaways from the report. First, on the environmental front, we reduced our water withdrawal by 16% in the first year since setting out our target, putting us ahead of schedule towards our 2030 goal of a 25% reduction. Second, we achieved 100% RSPO certified palm oil, including our sourcing from third-party manufacturers, and 99% FSC certified 14 boxes for our products, strengthening our responsible sourcing practices globally. We also introduced new retailer partnerships and opened our first multi-brand sustainability hub in travel retail, showcasing Coty's commitment to innovation and collaboration in ESG. Finally, we launched an online ingredient resource to provide consumers with clear, accessible information about what goes into our products. These achievements underscore Coty's commitment to advancing sustainability. Let me now wrap up with our key messages for today. Our strategic announcement made in September include focusing and optimizing our portfolio and resources behind our areas of strength. We aim to elevate Coty as a prestige beauty company with an emphasis on fragrance and scenting across price points, with best-in-class capabilities in prestige cosmetics and skincare. This includes closer integration of prestige and mass fragrance businesses, unlocking opportunities in ultra-premium fragrances, mists, and broader scenting, developing a performance improvement plan for consumer beauty cosmetics, and advancing strategic reviews of our consumer beauty cosmetics and Brazil businesses. Encouragingly, underlying business trends continue to improve, tracking in line to slightly ahead of expectations. We continue to anticipate a return to profitable sales growth in the second half of fiscal 26. In summary, our medium-term focus remains clear: outperform the beauty market, expand margins, continue to reduce our leverage, and deliver sustainable growth within our best-in-class fragrance and scenting portfolio, complemented by prestige color cosmetics and skincare. Thank you very much for your time today. We look forward to connecting on Thursday, November 6th at 9:30 a.m. Eastern Time or 3:30 p.m. Central European Time for our live Q&A session.
Good morning and good afternoon, everyone. My name is Madison and I will be your conference operator today. At this time, I would like to welcome everyone to Coty's first quarter fiscal 2026 question and answer conference call. On today's call are Sue Nabi, Chief Executive Officer, and Laurent Mercier, Chief Financial Officer. With that, we will now open the line for questions. If you would like to ask a question, please press star 1 on your keypad. To leave the queue at any time, press star 2. Once again, that is star 1 to ask a question, and we'll pause for just a moment to allow everyone a chance to join the queue. And we will take our first question from Rob Rottenstein with Evercore. Please go ahead.
Great. Thank you very much. I've got a few questions all around the Gucci topic, if you will. So, first, can you talk a little bit about how exiting the Gucci license will impact your overall portfolio, how you're thinking about it? And then, does the Kering announcement, along with L'Oreal, actually have any influence at all on how you're thinking about your overall licensing model? Any tweaks to that? And then finally, is it at all possible that Kering will try to take the Gucci license back before its expiration? And can you come to a deal with Kering in terms of an early license termination? Thank you very much.
Good morning, Robert. Thank you very much for giving me, again, the opportunity to speak about this important topic. So let me start with the first question, which is around how this is going to impact Coty's portfolio. So with the public announcement that the Gucci license will no longer be part of our portfolio after its expiry, as you can imagine, the focus of Coty for the next several years will be on, number one, will be overdriving the brands with the biggest long-term growth potential. Number two, we will be building, and I should even say amplifying, the new licenses and brands we have recently added to Coty's portfolio. And number three, in parallel, we will optimize the Gucci brand during its remaining term, while, of course, fully respecting and operating within all of its term. In fact, and it's important for me to have the occasion to say this, the uncertainty over the last few years around the fate of the Gucci license, resulting from the public comments of the licensor, were a challenge for the Coty organization and the Coty reputation, including whether to build the brand in a strategic or a tactical way, and also its role in our overall portfolio. And now, as there is full clarity on the brand direction, we now have a fantastic opportunity to grow the rest of the portfolio with a bigger sense of focus, especially on the ultra-luxury part of the business, with a comprehensive portfolio of ultra-premium brands. I'm thinking about Atelier des Fleurs from Chloé. I'm thinking about Burberry Signatures, Jil Sander collection, Infiniment Coty collection, and upcoming Etro and Marni collections. So even without the Gucci license, it's important to state that we remain firmly in the top 3 for total global fragrances and for prestige fragrances. And with this clarity on the fate of Gucci now, we will work work to optimize the brand in a more tactical way until the last day of the license, while focusing on accelerating the rest of our portfolio. As a reminder, and you have seen it probably in our prepared remarks, we have already grown some of our biggest brands at a fantastic pace in the last 5 years. Burberry by 140%, Hugo Boss by 33%, Chloé by 70%, Marc Jacobs by 50%, and we can now focus even more on further expanding these brands, while in parallel building our next stars with brands like Swarovski, just like we have built Gucci. You may recall that we grew Gucci by 60% over the same period at constant currencies. Now, I would like to take this opportunity, Robert, if you allow me, to stress that some of the delusional media rumors from recent months about Coty potentially exploring the sale of some of our key fragrances are categorically false. May I repeat, categorically false. We are committed more than ever to solidifying our position as a prestige beauty company with an emphasis on fragrance and scenting across price points, with cosmetics and skincare best-in-class capabilities. And as you can imagine, our long-term fragrance brands are the backbone of this strategy. Now, moving to the second part, which is a very important also question, which is around the impact of this event on the licensing model. I think that we can say that everything that happened confirms that the winners in beauty have been and will remain specialty beauty players like Coty. In-housing beauty remains incredibly complex, incredibly costly for non-beauty players, which reinforces the appeal of the licensing model. May I remind everyone about why this licensing model is really a stronger model. It offers strong return on investment with no material upfront license or renewal costs, while established brand equity increases the probability of success and of payoff. Again, a successful licensing business depends on portfolio diversification and on minimizing the license duration risk. In recent years, as you have seen, we have proactively renewed and significantly extended many key licenses, including Hugo Boss, Marc Jacobs, Adidas, Davidoff, and all these for an additional 15 years plus. So today, I would say that 85% of our portfolio is either an own brand, a perpetual license, which we view like an own brand, or a license with very long-term remaining duration of more than 7 years, 85% again. So for our core beauty portfolio, it remains also a very long term in terms of nature, with approximately 80% of the brands either being owned or under long-term license. We also have been very prudent, as I said it for many years now, that no single brand in our portfolio accounts for more than approximately 10% of our sales. Now I'm going to answer the last part of your question, which is around, an early exit from the license. So again, there is no change to Coty's existing license on our ability to operate the Gucci Beauty license. All contractual rights remain in place and continue as agreed. Coty will continue to manage and operate Gucci Beauty under the same structure already in motion. And overall, we continue to solve this amicably with Kering. Last part of your question, which is around a potential deal. As you can imagine, we are always open to evaluate any proposal if and only if this creates real value for the company.
Thank you very much.
Thank you.
You're welcome.
And we will take our next question from Susan Anderson with Canaccord. Please go ahead.
Hi, good morning. Thanks for taking my questions. I guess maybe just to follow up on the last question, I did see that Coty filed a lawsuit against Kering for breach of contract. I guess maybe if you could just talk a little bit about what that means for Coty, if that maybe helps to sell the license back early. And then also, I don't think you talked specifically about any financial impact when the Gucci license does transition to L'Oreal. Not sure if you could give any numbers around that. Thank you.
Yeah, good morning, Susan. So let me maybe start with the second part of your question, which is around, potentially the impact of this exit when it happens. As we have been discussing for some time now, we have been actively focused on risk management in the portfolio of Coty. And again, as I said it earlier, no brand bigger than approximately 10% of our sales. Now that the public announcement has been done, that the license will no longer be part of our portfolio after the expiry date, our focus for the next several years will be on overdriving the brands with the biggest long-term growth potential. It's going to be also on building and amplifying the new licenses and brands we recently added to the portfolio, and in parallel, optimizing the Gucci brand during its remaining term. As you can know it, Gucci is currently a sizable brand in the portfolio, so the loss of the brand at expiry will mean some profit impact in the year after. To address this gap, we will be overdriving, again, all the other rest of the portfolio, while also addressing our cost structure. Now, regarding litigation, what I can tell you is that, of course, I will not comment on ongoing litigations, and I can tell you that we will defend our rights until the last day, until the last hour of the contract.
Okay, great. Thank you so much. Good luck this holiday.
Thank you very much.
Thank you. And we will take our next question from Filippo Falorni with Citi. Please go ahead.
Hi, good morning and good afternoon, everyone. Sue, maybe can you comment a bit about the better performance that you're seeing fiscal Q2 that is driving you to the higher end of the range? Are you seeing an acceleration in some category growth? Is it the inventory dynamic solving itself earlier than expected? And then I had a bigger picture question on the fragrance mist. Can you just help us dimensionalize opportunity in that category and also just the margin profile as you expand there? Thank you.
Yeah, good morning, Filippo. So on the first question regarding the better performance that we are contemplating for Q2, which led to our, increase in terms of being at the more favorable part of the guidance for Q2, I would say that it's a mix of everything. In fact, the dynamism of the fragrance market in the U.S. continues to be very strong. Again, we are talking about a market that's in the mid-single-digit growth, and what we see in Q2 in terms of market dynamics is confirming this element. So we believe it's going to be a good holiday season. This is number one. Number two, our innovations, specifically the Boss Bottled Beyond launch that started at the end of the Q1, more or less, and it was exclusive to travel retail during the summer until the end of August. So it all started in domestic markets around the end of September. This is such a big success that I believe it's going to translate into a stronger selling also for Q2. Boss Beyond Bottle is today the number 2 innovation in Europe, the number 1 innovation in volume in the DACH region, number 1 in Australia, and even number 6 in the US as an innovation for a brand that has never been a US, I would say, traditionally present brand on this very important market. So for us, it's really a big strategic bet, and it looks like it's going to be very, very big, which will help us to increase our market share in the male fragrances, which are also booming, as you know it. Number 3, I think the dynamism is also at the entry part of the market, which is around the, entry prestige brands, but moreover around the mists. The mists today are representing more or less 2% of Q1 net revenues in fragrances, which is big, I have to say. We have become the number 3 or number 4 player in Europe, number 1 in Italy, to take a few examples. Everywhere or every brand that launched its own mist is seeing a very strong halo effect on the base business, be it Kylie, be it Philosophy or Calvin Klein, that are the first to go to market, and there are other brands arriving soon. And last but not least, you had a question around the gross margin of mists. The way we have built these mists is number 1 to make them fully additional, and this is really confirmed. It's really incremental sales for the company, attracting consumers, which are the youngest part of the Gen Z target, which are not usually buying into traditional fragrances, to that level. So this is one. And two, it's a gross margin that is in line with the one of our prestige fragrances. So there is absolutely no dilution in the way we have crafted and created this new category. So in a way, this Q2 better than expected, outlook is driven by our ability, and I guess we are the only company doing this, to play high-low, while at the same time securing the heart of our business, which are premium fragrances.
Thank you. And our next question comes from Oliver Chen with TD Cowen. Please go ahead.
Hi, Sue and Laurent. As we are excited about the second half here, what are your thoughts in terms of the key launches and how you'll think about categories and the comparisons as well that will give that return to that growth in the second half? Also, as you think about consumer beauty in Brazil, would love your thoughts there on potential outlines and outcomes and timelines. Thank you.
Yeah, thank you. Good morning, Oliver. So indeed about H2, and indeed we are confirming that we will be back to growth in the second half of this fiscal. So that's the number one message. So, what is, behind this number is that indeed, the continuing momentum on the beauty category, and especially of the prestige and fragrance category. So we see really consistent, resilient growth of this category. And again, you see the numbers. If I take the Q1 category, fragrance growth in the US, which is a plus 7%, and our sellout in Q1 is in line with this category growth. And indeed, all the work that the new management team is putting in place in the US is really confirming that this trend is going to continue and amplify in the H2. So that's very important category. And the US, which, as you remember, was the main issue that we had a year ago. Now we are really already, in a good place that we are recovering very fast. So that's really the big element. It's going to be amplified by strong innovation. So as you heard and as you saw, Boss Beyond Bottle is off a very good start. And of course, it's going to continue and amplify. And we are coming also in the second half with an additional blockbuster. So again, the fundamentals of this growth are here. And the last element which I want to highlight, which is very important, is that indeed at the end of this calendar 25, we are seeing that our sellout performance will converge with the sell-in performance. So indeed, we are seeing already this quarter, and we continue next quarter, that the level of inventory with retailers is declining significantly, and indeed that we can really be back to really a well, synchronized sellout and selling. So these are really all the drivers, the key drivers, confirming indeed having our H2 back to growth and of course to continue on this growth trajectory. So indeed that's really on the H2. So indeed on consumer beauty cosmetics, again, we announced and we made very clear that indeed now is really led by Gordon von Bretten, who, as you know, knows very well the company. He was, head of transformation, a few years ago. And, Gordon is really currently assessing and really reviewing, the full potential of this division, working on all components. So the number one mandate, of course, is really to rejuvenate really the P&L, the profit and the cash generation from color cosmetic. And I can tell you that Gordon is already full speed, really, built already a strong team, really to manage all these key initiatives. And I can tell you it's covering the full spectrum, again, of the P&L, starting, of course, with top line, gross to net, gross margin, A&CP allocation, and of course the fixed cost. So it's really in motion, and we will keep you posted, of course, on the progress on this journey. second, which is on Brazil. As you know, Brazil is a very is a profitable business. I mean, really the work done over the last years really has brought very, very good result. And indeed, I mean, conclusions on Brazil are likely to come before than on consumer beauty, than on color cosmetic business.
Thank you. And we will take our next question from Olivia Tong with Raymond James. Please go ahead.
Great. Thanks. Good morning. With respect to fragrances, you've got a really substantial growth both in ultra prestige and mist. So can you talk about the opportunity you see for both of them and more importantly, how to balance the two, particularly in terms of the mist side? And then just building on that, just thinking about the barriers to entry on mist and then what your view is on price mix impact over time, given those dynamics. Thank you.
Good morning, Olivia. Let me take this question. So again, let me start with the mist part. So this mist, as I said it earlier, we really designed them with 2 or 3 principles in mind. The first principle is that we have to be where the Gen Zs and the consumers are shopping today, and they are shopping this kind of fragrances. You could think about a mist like a kind of modern cologne. It's not new, the mist, but the way we've designed our mist maybe is the comparison that could be done between a Nokia mist and an iPhone mist, more or less. That's exactly what we have done. And on top of this, we added entry barriers. Indeed, it's a very important element. First, in terms of our ability to use the library of winning scents from our prestige division. And number 2, I can tell you that the formulation of our body mist, whatever is the brand, are patented formulations using ingredients that are there to act on the longevity of the scent on the skin of the body. And this is really a unique know-how to the company, which allow us to do what a lot of brand mists have not been able to do so far, which is to create a lasting impression. If you read online what people love and hate about the mist, they love that it's easy to spray. It's also stackable. The mist phenomenon is incremental because a lot of young users use it as a lingerie, and then they add their favorite fragrance at the main outfit on top. So it's not instead, it's with the rest of the fragrance consumption. And if you look at social media, the number one need gap is that it does not last. So this is where we use this patented technology that allows the fragrance to stay on the skin as true as possible from the moment you spray it on to the end of the day. So that's the first element regarding the mist. And for me, the mist is just a first step into what we call scenting everything, which I believe is the mission of the company, the know-how of the company, and the competitive advantage of the company. So you'll see many more things arriving in the near future around scenting your body. Number 2, which is around the ultra-premium part of the market. This part, we used to call it niche. I think niche is really a wrong word because it's not that niche, in fact. Today, if you look at the biggest niche brands, they represent multiple hundreds of millions of dollars of net revenues. In a country like the US or in a country like UK, it's close to 20% of the prestige fragrance market. So it's a sizable portion of the market and probably the most profitable part of the market too, given the high prices that are used in this area. There, it took us some time to build a portfolio, but now we have a portfolio. Again, there aren't that many companies that have a portfolio of ultra premium brands. Again, I quoted earlier, of course, the Chloé Atelier des Fleurs collection, the Burberry Signature collection, the Jill Sander collection, the Boss collection, the upcoming Marni and Etro collections, and of course the own brand, which is Infiniment Coty Paris. And we are continuing to chase new names in this area so that we are able to build a Coty ultra premium business that represents between 10 and 20% of our business. And today it's only 1%. It's growing at 17%, but we start from a small base. So for me, this is a fantastic growth engine for the future of the company. So again, we are the only company playing high-low on top of the core of the market.
Thank you. And we will take our next question from Ashley Helgans with Jefferies. Please go ahead.
Hi, this is Sydney on for Ashley. Thanks for taking our question. Can you talk a little bit more about what you're seeing in terms of promotion and how that maybe varies by region or channel? It sounded like there was some challenge from peers leaning into promo, so just curious if that puts pressure on you guys to shift your promotional approach at all. And then also just curious about any trade down or up dynamics. As you've mentioned, you are, really spanning price point, especially within your fragrance offering. So curious kind of what you're seeing there in terms of consumption trends. Thank you.
Yeah, good morning, Ashley. Indeed. So, indeed, we are seeing, some promotional activity. Indeed, I can tell you, indeed, from some of our peers. We are very disciplined and very diligent, really, not to be aggressive on that game. So indeed, we are very choiceful, really focusing on, again, on innovation and continue really to protect indeed our brand. So, and we are also developing really some ways to avoid this game, which is, as we shared a few times, now we have really, dedicated teams working on revenue management. And revenue management is exactly how to avoid playing this kind of, promotional game. I give you some examples is in the US, one category which is growing fast is a pen spray. Pen spray are smaller format, 30 milliliters, indeed lower price. And indeed, instead of promoting, some of our icons, in fact, some consumers can go to this segment, and it's also a smart way to enter the category. And then they go to the icon. So we are really developing different formats, different games, exactly to match also sometimes, some pricing expectation. At the same time, what is very interesting and was the previous point from Sue is that you are seeing that, the high premium category is flying. Okay, so it shows that we have really, with really our capabilities, our know-how, and really all the formulation and, that we are bringing, there is really a path that it's not, of course, it's not, only about price. It's really about always, the excitement about the category. So I think, again, we are very well positioned, and you understand that this 5 to 500 is the best answer to this promotional environment, because we are covering the full spectrum. We are, matching the needs of all our consumers. And indeed, I can tell you, so we are very choiceful, and we are making sure indeed that we are protecting our profitability. So, and on your last point, trade down versus trade up, that's exactly this point about the 5 to 500. So is really managing the full spectrum. Body mist is also, a very great answer to this question. We are seeing Gen Z very excited by a body mist. It's $20 to $30 product that they really enjoy. Different formulas, as we indicated, and then it's also a path at some moment to access, to more premium products. So you're absolutely right, but I think all the strategies, the teams, and the tools that we have in place are really helping to navigate in this environment.
In fact, to complement what Laurent just said, we are seeing clearly that consumers are stacking, the scents. This comes from the Middle East. This is a trend that's globalizing. We call it scent stacking or scent wardrobe, depending on the moment. So it's about using a body mist on your skin and then using a lotion on the rest of your body. And on top of this, you add your favorite cologne for the day and your favorite elixir for the night. So that's exactly what we are seeing. So no trade down, because the more expensive categories are the fastest growing, but it's a story of and rather than a story of either, in fact.
Thank you. And our next question comes from Charles Coty with Kepler. Please go ahead.
Yes, hello, good afternoon. Do you hear me?
Yes, we do.
Yes.
Good morning.
Okay, good. Thank you. Good morning. I have three questions, please. The first one, how is the shift toward e-commerce affecting the sell-in, sell-out dynamics? I suspect that brick and mortar retailers are experiencing some destocking partly due to the intensifying competition from online players. So I would like to understand whether the shift to online, particularly in the US, could lead to a prolonged period of net destocking in that market. Second question on EMEA, which, if I'm not mistaken, was on 9% like-for-like in Q1. It seems that it's the mass color cosmetic business which is dragging on growth. Could you comment on the trends of the prestige fragrance business? You mentioned mid-single-digit growth in the US. What about EMEA? And if you could give us an idea of the price mix volume breakdown of the category, both in EMEA and in the US, it will be helpful. And lastly, in China, demand seems to be recovering. You are obviously under-indexed on the Chinese market, but you mentioned that the outlook for the fragrance category is quite promising. Who do you think will take the lion's share of the market between the niche brands and prestige brands? And with which brands are you going to tackle the Chinese market more specifically? Thank you.
Yep. Yeah, good afternoon, Charles. So indeed, I can take the first one, indeed, and so we can complement it on China. So indeed, on your question about brick and mortars and e-commerce, just to zoom out a little, yeah, of course, I mean, e-commerce is growing very fast, and you know that now it's more than 1 billion net revenue for Total Coty Inc., and it's growing fast. In the Q1, we are seeing, I mean, the sellout of our e-commerce on both divisions is 5 to 6%. So indeed, we are really taking full opportunity of these channels. So that's, of course, very dynamic. From a destocking standpoint, no major difference, between both. What I would highlight, though, is that, of course, we're e-commerce players, and the number one being Amazon. As you know, they are, very strict and very well organized on their inventory management. So indeed, it means that it's creating, if you look at full picture, indeed, reduction of retailers' inventory. So indeed, you have, I would say, I call it more a mix effect, from between e-com and brick and mortar. So that's a fact, but it's not material. The other element is also that it's putting pressure on the brick and mortar retailers. And as a result, they are also becoming more disciplined and strict on their inventory management. So I think you need really to look at it more this way, between both channels. EMEA, down. Indeed, it's mostly color cosmetic. Indeed, as you see for the whole company. Indeed, our prestige fragrance sellout is positive. So it's really dynamic, and again, all the innovations that we are bringing. I mean, Boss Beyond Bottle is the number 2 male initiative in Europe. It's number 1 in volume in Germany, and we are only at the beginning. So it's going to continue and amplify in the Q2. So you will see really the sellout in EMEA continue to increase. At the same time, same as the US, we are still facing, and we will close by end of calendar. Indeed, from a selling standpoint, facing the retailer destocking. And for example, Douglas made public that they are focusing on inventory reduction. So these are really on the first two elements, and I will hand over to Sue.
Or maybe I can complement your answer regarding the dynamics of the fragrance market in the US versus in Europe. Again, what we can say is that the prestige fragrance market grew by 5% during the quarter globally, which is a little slower than months ago, but it's ahead of many other consumer categories, including color cosmetics. In the US, the market remains very strong. As I said it before, 7% of growth in the quarter. And very importantly, this is to answer your question mentioned. This includes low single-digit volume growth since the category continues to gain users and additional usage occasions. In Europe, the picture is a bit different, where the market has been growing only by low single digits in Q1, coming from mid-single digits. This is mainly due to one market. It's very important, where, by the way, Coty is quite small. It's the French market, where the likes of L'Oréal, LVMH, and Puig are very big. It's the market that is really very big and not very dynamic, whereas markets like the UK and Spain remain very strong with a mid-single-digit growth, including here again low single-digit growth from units. So that's the picture between US and EMEA, value/volume growth. Now on China, the market is recovering. That's good news. It's recovering on all the categories that the company is playing on, be it skincare, fragrances, or color cosmetics. Coty has posted 15% sell-out growth in the market, to be compared to a market that was around 7% of growth, which is a good growth. And this was driven by our skincare business. Lancaster is doing wonders in this market, which is very important. It's the most competitive skincare market in the world, even if it's from a small base. The brand is doing 90% of growth on a market that's more or less 8 to 9%. So we are growing 10 times faster than the market, both in photo protection, which is UV care, but also on traditional skincare with our moisturizer, among the best-selling moisturizers of the Chinese market. The other part, which is the biggest part of our business, it's 70% of our business, it's fragrances, and there the market is back to growth, and we are growing 2 times faster than the market. So your question is, what is needed to compete on this market? Exactly the brands we have at Coty, in fact. There, it's not a question of high-low. It's all about high, 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 and the higher you go, the better it is. And again, I've been describing at length the very comprehensive portfolio of ultra-premium brands that we have today in our hands. Atelier des Fleurs, which is phenomenally doing well in Asia, Burberry Signature, Boss Collection, Jill Sanders Signature, Marni and Etro upcoming collection, Infiniment Coty Paris, and I'm sure I forgot one or two, but this is really a portfolio that will allow us to play in this area like never before, to reach here not 20% of the market, but likely 40 to 50% of the Chinese market are ultra-premium brands. So there is really a big game to be played with a very, very profitable business to build.
Thank you. And we will take our next question from Anna Lizzul with Bank of America. Please go ahead.
Hi, good morning, good afternoon. Thank you so much for the question. I was wondering if I could follow up on the prestige fragrance expectations for just the holiday season. Gifting is such a big driver of fragrance sales for many retailers during this time. And should we expect trends, I guess, be more similar as you saw in fiscal Q1 on the more difficult comps for prestige fragrance gifting, despite some of the sequential improvement that you might be expecting in the next quarters? And then on the mass beauty side, just wanted to follow up on the comment regarding the rapid channel shift. If you could elaborate on where you're seeing buyers gravitate in mass beauty and how it's impacting your business. Thank you.
Yeah. So good morning, Anna. Indeed, I mean, just to confirm again, and we shared with you a few numbers. I mean, we are, very confident again about, the prestige fragrance performance and category. Again, the numbers. I mean, it has been, very resilient for many years, many quarters. The fragrance index that we talked a lot about, I mean, is fully at play. So we are expecting, similar trend for Q1, also amplified by very powerful innovation, and Boss Beyond Bottle is one of them. We are seeing Gen Z being very, very excited by the category. And again, back to the previous point, what's very healthy is 5 to 500, where we are seeing, the high premium category growing double digits. And of course, holiday season is a great season for that. And at the same time, we are seeing entry premium being very dynamic. So yeah, we are expecting really very dynamic trend in the US and also in Europe. So Now on the...
I can take it.
Yes, yes.
So, and if I understood well, your question is about the shifts that are happening between, let's say, the brick and mortar slash e-retailers on one side versus Amazon and TikTok Shop on the other side. If I'm not wrong, then I will elaborate on this. What we are seeing indeed is a shift that's very important. And it's a story of and rather than a story of either, again here. It's a question of funnel. And what we see is that a lot of the youngest consumers, at least, are really looking for what's new on TikTok, almost like a search engine and a hype engine at the same time. It's already also an e-commerce engine, not in every country. It's the case in UK. I think it's the second beauty retailer already in the UK. And this is where we learned our lesson with Rimmel, where we really tested the channel to understand how, to play with this channel. And we understood that we need to see it as an investment channel, now more and more as an e-com channel. But this is really where you create the cool factor for your brand. And then you move to Amazon, where you get the ratings and the big numbers. And then after you go to the rest of the retailers, including .coms from retailers. So that's really a way that is today played by key players when it comes to how to create virality or how to create desirability and demand. So we are doing this in the US also with CoverGirl, that also did a test on a TikTok Shop recently, and we are amplifying these two moves in the coming quarter with the new innovations that are going to be done in Q3. The other thing that we are also seeing is that there is also a shift in terms of the share of what we call indie mass color cosmetics brands. If I take the example of Emco Beauty in Australia, which was a kind of, this kind of indie brands that are quite cheap in terms of pricing, very nimble, very agile, mainly from the shelf innovation from TPMs, etc. They are collapsing. They are collapsing after 1 or 2 years, and this is really something that we are seeing across many regions with this kind of players, including key ones in the US, but also in UK, who are starting to lose market share and who are not giving the growth of the category that retailers are expecting. So we expect a kind of, inside the channels, we expect a kind of rebalancing between these indie players, which are more or less dupe players, and the more traditional players, which are learning the lesson quite quickly.
Thank you. And we will take our next question from Shivana Chaudhary with JP Morgan. Please go ahead.
Good morning and good afternoon. Thanks for taking my question. I have a couple questions. You addressed the strategic review to Oliver's question earlier, but I wanted to dig a bit further into how you're thinking about the various options. Can you give us more color on the results that would inform your decision for each of the options out of this review, whether you decide to keep the business given like you're trying, you had management changes and you just mentioned you're trying with CoverGirl testing out on TikTok, or would it be a JV or an outright sale? Given the strategic review, how do you prioritize the decision of the strategic review versus the Wella sale? Thanks.
Okay, let me take this last question. Good morning, Shivana. So indeed, what we are doing are two very different stories. So you have on one side the Brazilian business, which, as Laurent stated it before, is a very profitable business, a business of $400 million, a business that doubled its size in the last, I would say, decade, a business that has its own factory that produces more or less 500 million units per year, R&D specialized in melanin-rich skins. You have also end-to-end capabilities, be it in terms of digital capabilities, commercial capabilities, marketing capabilities, and last but not least, with a portfolio of brand that is very different from the global portfolio of brands that Coty is operating elsewhere. So it's really local players, the number one nail maker, Risqué, the number one, male skincare brand in the market, big growth in terms of face skincare, leadership position in terms of body scenting. So it's really a business that we believe have potentially more chances to continue to do its journey with a new acquirer, if I may call it like this. And this could happen quite quickly, given the size of the business, the profitability, and the dynamism. So that's one. On the other side, regarding the color cosmetics business, there, again, the strategic review is a real one. It's not, just a word to mean something else. It's really reviewing our strategic options. The first one is by nature to do the job of making this business as fast-growing and as profitable as possible and as quickly as possible. And there, the duo that Gordon and myself are having at the helm of this business hopefully will produce quick results that we will see in the coming quarters. Then there is a deeper work that's going to be done on the cost structure, on the gross to net, ability to lower this part that is today very, very heavy, but also on the ANCP allocation. We believe we went too far in terms of spending a lot on Gen Zs, who are by nature the least loyal consumers on earth, instead of keeping our key loyal millennial and Gen X users, which are the big portion of the market, but also the ones that are growing more and more this kind of market, given the indie brands are not growing anymore the market. So in a way, that's really the outcome potentially of this part. And there, the first results in 12 to 18 months, but it could take longer. So there is not the idea to sell the business tomorrow. There is the idea to really assess all the possibilities and see if this is an area where we want to continue to play or not, specifically given the fact that it's going to be more and more, and we see it, a business of in and out, small players. Sometimes they go big, but they become smaller later, and they take a shelf space and they disappear. So that's really something we need to pay attention to. Do we want to play this game or not? Are we equipped to play this game, and are we able to do, I would say, positive progress in this area? Now, does it have any impact on Wella? Absolutely not. Wella is a very separate topic. As Laurent said it several times, the standstill period is over since the end of calendar 24. We are actively, more than ever, working on this topic right now, so stay tuned.
Thank you. And at this time, there are no further questions in queue. I will now turn the meeting back to our presenters.
Thank you, everyone, for your questions, and see you soon.
Thank you. This brings us to the end of today's meeting. We appreciate your time and participation. You may now disconnect.